Hello and welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking concept practitioner, and today I'd like to talk about this idea that life insurance companies are all going out of business because of a certain thing that happened in 2020. Won't name the thing, but we all know what that was, and we all know what the aftermath of that thing was. Okay, so the claim is, and you can certainly find articles to this effect online, but the claim is that insurance companies are not able to handle the increased number of deaths after 2020. They are going out of business. Will they be able to pay dividends? I'm not sure I should do infinite banking. I don't really know what repercussions this might have. I don't want to put a lot of premiums into a policy that's going to get canceled by the insurance company. Okay, that's the line of thinking. That's the thought. I wrote an article some time ago on our blog, which I'll link in the description box, talking about this in a little bit more detail, but I do want to just verbally talk through it as well. Some insurance companies may be in trouble. There is a law on the books that prevents me from speaking negatively about specific insurance companies, so I'm not doing that here, but you do have to think about what kind of insurance company you're working with, who has your policy, who their parent company is, those sorts of things. A company that is primarily focused on term insurance. Let's talk about that. Term insurance is inexpensive. Why? Well, generally inexpensive, right? There's exceptions. If you're young and healthy, have no major medical conditions, then you can go get a 10, 20, 30-year term insurance policy and have a quote-unquote low premium. If you get one of those policies, you need to know that the assumption being made by the insurance company is that you probably will not pass away during the time period of that policy. The more likely it is that you'll pass away during that 20, 30-year period, the more your premium is going to cost. And so you reach a point, this is approximately age 80, depending on the insurance carrier, at which you can't get term insurance. You can't get insurance at all because your likelihood of passing away is very high. So let's say you're 55 and you get a 10-year term policy. Well, that takes you to age 65, right? But you can't get a 30-year term policy as a 55-year-old. It's not offered. Why? Because you'll actually use it. Okay? But if you insure, and this is how insurance companies work, if you insure, say, 1,000 people of similar health, same sex, roughly equal risk class. You insure 1,000 of those people, you charge them the same premium, maybe one of them will die. Well, your premiums that you have taken in as an insurance company from all 1,000 people should be enough, plus the investment income from the company, should be enough to pay the death benefit. It's the whole business model. But that means that, much like insurance on your home, your house is not likely to fall apart every single day, right? It's a very, very low likelihood. But if somebody's house burns down, you want to make sure that there's coverage, right? Because it's a big expense. So it's a major blow financially to try to rebuild a house from scratch because it burned down. Homeowners insurance, that's what that is. This is just that applied to life. You have a specific amount of death benefit, and they're going to pay it if you're the one out of the 1,000 people that passes away. But again, the assumption is that maybe one of those people who are young, healthy, will pass away per year. Okay? You can look at the actuarial tables. It's available online. It's not hard to find. You can see how many people are considered likely to pass away within a given age bracket, within a given time span, et cetera, et cetera. It's all available. It's the actuarial tables. Now, because they are not charging very much in premium, they can't afford for, say, 5 people per year to die out of that group of 1,000. They can't afford it. They don't have the money for that. Maybe for a year or two, but not on an ongoing basis. Okay. If a company only sells term policies, you can now understand that that's a problem because their entire business model is, well, we're going to sell a whole lot of policies and not very many of them are going to need to be claimed. It's not entirely dissimilar from fractional reserve banking. Banks don't have all the money that's deposited at them all the time. The assumption is that only a small fraction of people will need to make withdrawals on a daily basis. Okay, so if something significantly changes that, it's a problem. That's how it works. Now we talk about a company that sells universal life and term. Okay, it's kind of still a problem because universal life is based on annually renewing term. It's got flexible premiums. There's a lot of reasons why this might lead to a problem for the insurance company. Whole life insurance carriers, on the other hand, they're very cash heavy all the time because their owners have a contractual right to take policy loans against the cash value in their policy at any time, and they are insuring people for their entire life. In a modern policy, that's to age 121. So you imagine the likelihood that you'll pass away before you're 121 years old. That's pretty high. That's pretty high. So they have the money. They take in enough premiums, they manage their investments in a long-term oriented fashion, they overcharge premiums. Sometimes people think this is a bad thing. They charge more in premiums than they actually need, and then, based on their actual investment performance and their actual mortality expenses, in other words, the actual money they have to pay out in death benefits for that year, and their actual staffing costs, all the different things that go into that, the actual numbers are tabulated at the end of each year, and they go, okay, we still took in enough money to cover all of our needs, we'll cover all of our future expenses, we're good to go. We can declare a dividend. And then that dividend is given, shared with the policyholders, because the policyholders in a mutually owned life insurance company are the owners of the company. The people who own the company are the people who own the products, the policies. That's how it works. If a life insurance company was going to have a problem and they weren't able to meet their obligations, they weren't able to pay the death benefits that they must pay according to these contracts, then a leading indicator of that would be that dividends would be going down. Dividends might not be paid at all. The financial statements, which are released by these companies every year, would start to look pretty bad. But none of that is happening. We have two insurance carriers at the time I'm recording this that we work with. Both of them just announced dividend increases for 2024. No problem detected. They can't afford to do that if they have larger than expected mortality expenses. You see what I'm saying? But yes, some companies, particularly abroad, where the life insurance laws are a little bit different than they are in the United States, and the assumptions going into the creation of life insurance companies are a little bit different. Some companies definitely are in trouble. But that doesn't mean that life insurance as a class is a bad move for your money. Doesn't mean that they aren't able to steward that money. If anything, and I make this claim all the time, if anything, the money is better taken care of and is actually there in a life insurance company versus a bank. Banks don't have your money. They loan it out as soon as they get it. They make new money out of thin air all the time. Life insurance companies don't get to do that. If you're concerned about the increased mortality, if you're concerned about what happened in 2020 and how that might affect life insurance companies, here we are, January of 2024. When I record this, it is not a problem that I can see based on the evidence available to me. At least not for the companies that we work with. Also, if you have any other questions that you just prefer to do a little bit of independent study instead of reaching out, totally understand. I wrote a book that covers a huge swath of financial topics. It's called Between the Lies, How to Reclaim Your Future from the Banks and Wall Street. You're going to find a link to that in the description as well, betweenthelliesbook.com. You'll find the digital copy, the paper copy, and the audiobook narrated by me. Thanks so much for watching. We'll see you in the next video.